Mike Carrodus. First of all, have I pronounced that
You're one
correct?
of the few people that do, so thank you for that.
Oh, well, look, I'm so glad we're doing this podcast. We've already had a couple of technical issues, so we won't worry the audience about our technical issues, but such is the joys of running podcasts. So, Mike, as I do with everybody, could you do a brief introduction to your good self? Who is Mike Carrodus? What's your background, etc., etc.? And then talk a little bit about substantive research. And I think I did ask you beforehand to comment on the Euronext, but I think you're then, we've worked out a way to segue into that more smoothly. But give us the starting point. And I should stress to the audience, Mike's LinkedIn profile will be in the description below, and the Substantive Research website is below to click on.
Yeah, absolutely.
But tell us something.
So, Mike Carrodus, I'm CEO of Substantive Research. We are a quantitatively driven price benchmarker in the research and market data markets. And what does that mean? We provide transparency in very opaque places, trying to basically get very granular and therefore give people numbers that are actionable. And I'm sure we'll talk about that in a lot more detail.
We will.
And then, personally, I started the company in 2015, in January of that year. And so we haven't had a 10-year birthday party because we were too busy, but we are going to have a summer one. So we are doing that. And previous to that, I was running the commercial side of a research house called Ned Davis Research, which was very quantitatively driven, consumed a lot of data, but equally obviously helps you understand both the way that research and data is consumed. And previous to that, I was a publisher. I used to publish a magazine called Euromoney, which did a lot of surveys and rankings and all those sorts of things. But that was in the days when people read things on paper, David.
I do remember that, magazines. I could tell you one about how I started life, selling advertising in young women's magazines. But that's another story for another day. So look, I think we've got a good segue. We are going to talk about three broad topics. We may go off at tangents. Hey, that's half the fun of this. But I think the three broad topics that we're going to cover is that research one. So research is where you started, and you're doing a lot on that still. So we'll talk about research. Then we'll go into a topic that keeps coming up on my podcast, this cost containment, cost management, cost reduction, whatever we call it. We'll have a good old talk about that topic. And then I think a slightly newer area for you, research is where you started, but you've moved into this benchmarking area. And I've already had a couple of podcast conversations on that. So I'm eager to hear more about your perspective. So those are the three chunks of conversation we'll try and squeeze into an hour.
Yeah.
As I admitted to you beforehand, I mean, I'm relatively unfamiliar with the research topic. The bit I remember related to MiFID, and MiFID had this concept of trying to unbundle research. It was, I believe, the whole point was that the EU or the market didn't like the idea that big sell-side firms with their research analysts were bundling research with their general services, and that meant independent research houses were at a disadvantage, and that unbundling was supposed to solve all that. And strangely, I get the feeling it hasn't. But what's got on?
Yeah, so let me sort of categorize kind of where we are and how we got here. Where we are right now is a slight rollback from MiFID II because, I mean, politically, I think a lot of people were looking at trying to send messages to the general public that they were trying to increase the competitiveness of either the UK or the European Union capital markets. But essentially, MiFID II came out to protect investors. And, as usual, there were some unintended consequences. So if you are a buy-side institution that's either based in Europe, in the EU and the UK, or you're a global firm with large operations in Europe and the UK, you have ridden a very interesting roller coaster ride. You've probably had a few tears in a corner every now and then. Because what happened was that essentially it all looked a bit dodgy to the FCA. They said that trading and research was all bundled together, and all these millions of pounds were being recharged onto pension funds and other asset owners without really any accountability or transparency about why that was and where the value for money was being created. And so maybe if I wanted to be really important to you, Broker X, I would be a really big research counterparty using someone else's money to give you tons of cash. But actually, I was just really happy I'm a really important client overall, and maybe I benefit in lots of other ways in the way I deal with you as a broker or a universal bank. And so that is the area that they were honing in on, and I get that. There was a lot of money moving around with not a lot of transparency. A lot of buy-side organizations would say that they already had a pretty forensic research valuation and consumption process going on. But anyway, in the end, The laser focus comes on, MiFID II hits 2018, January, and suddenly all these buy-side organizations have to have these really rigorous research, valuation, and consumption processes, an ability to basically say, if I was a pension fund and I said, look, you just charged me this much money for research, I didn't see it before because it was all in trading. It's a bit like you're paying for Sky and then you suddenly found out that 30 quid of the 80 quid was movies, and you start going, well, do we watch movies that often? So the minute you unbundle or you show transparency to something, you invite questions. And what the key thing that happened in 2017, as we approached this deadline, is the European buy-side community decided, we don't want to have that conversation. We're just going to pay for research ourselves. And so the big thing that happened was that research hit the P&L of the buy-side in Europe for the first time. And so as you can imagine, scrutiny on costs went up massively, which kind of answers the FCA's question. And so we provided that apples to apples price benchmarking in research and basically helped, we weren't trying to create an adversarial situation, but essentially the market was trying to clear in real time where it never had to before with a supply and demand curve and come up with a price for things, which is very difficult in research. Market data is difficult because of opacity, but in research it's difficult because it's a relationship half the time. So actually there are a lot of challenges to that.
And I mean, my sense from monitoring it, I haven't monitored it that closely, is that it's sort of regressing. There was that whole thing from MiFID II in 2018. And then I've been reading things that actually they're thinking of going back. I mean, I'm going to say something a little bit political now. And I'm observing, not saying what's the rights and wrongs of this. But again, if you look at economics and you look at free market capital economics versus some sort of socialist. I mean, I always remember O-level economics, the idea of a planned economy or a mixed economy and whatever. And the point is, whenever governments, and I would say regulators are a bit of government, try to interfere in markets with the best intentions, they get the law of unintended consequences. I mean, I don't know. I mean, it's an interesting point about regulation because I've been watching other MiFID regulations, the consolidated tape and reasonable commercial basis and all that stuff. And I do genuinely believe that the regulators had the best intentions at heart. But then I also remember my mother saying to me, darling, the world isn't fair. When I say it's not fair, mummy, the world isn't fair. And I don't know, the regulators are trying to make everything fair.
Yeah.
I don't know, can we have a fair market?
I mean, here's the thing. One client put it to me like this recently, which was, maybe we've got to the right place at the end and none of us would have chosen this journey. So at the beginning, you've got a lot of money moving around with not a lot of accountability, an asset owner that isn't really understanding what they're being charged for and the value that they're getting for it.
Yeah.
Then the regulators overreach. Really, I mean, to be honest, it's a slightly painful rollercoaster. 7,500 years of experience was lost from the sell-side analyst community in the 3 years after MiFID II.
Because analysts left or were sacked? Or...
Yeah, because the pricing plummeted. And so, there was a right sizing of teams, as they would call it. And okay, yeah, some of that research maybe was overcapacity. But there was some definite, talent, high talent, differentiated work that left the market in much the same way that, some great newspapers, left the market in the dot-com boom, and it was just and the dot-com crash, I suppose, as well. So in the end, we lost some great research. And I think some companies also felt they were being undercovered as a result, especially at the sort of smaller end of the spectrum. And so then the politicians and the regulators come in and go, right, okay, have we gone too far? Then they say, yes, they've gone too far. And actually, only at the end of last week, a policy statement came out from the FCA, which confirms that it doesn't matter if you're a buy-side firm looking at your segregated mandate business or your pooled funds business, all the rules are now aligned. You can go back in a fairly straightforward way to charging your end investor clients for research. But now all the research budgets have gone down. That recharge would be less than it was, 6 or 7 years ago. And there's a lot more scrutiny. There's consumption tracking, there's internal processes to validate what's being spent, and there's also a qualitative overlay about whether the work actually penetrated the fund manager's investment process and helped them make good decisions. So I think that there's a number of people that we work for that would say that we're sort of getting to an equilibrium where there's rigor, but there's also the flexibility. Like, for example, if you're running my money right now, I want you to have access to someone who can talk about tariffs to you. Now, if the regulations make you not able to do that and you have to wait till next year, well, that's a bit late for my money that you're running right now. So there's this balance between asset owner cost and asset owner service and performance.
How does this work geographically? Because we're talking about MiFID was an EU regulation. Now, a vast amount of research must come out of the US. And I presume there's an APAC research capability or whatever. And I presume this MiFID 2 edict didn't affect or didn't encompass North America and APAC. Well, how did that play out?
I mean, that's a really interesting question. So the big thing that's happening right now is everyone's trying to guess how much of the buy side in Europe moves back to a commission sharing agreement driven research process, which means that essentially the asset owners are funding the research budgets again, and all the hopes for expansion of coverage and all the things that could have. But everyone's kind of checking whether they're brave enough to go and ring up their asset owner clients and say, "It's all right if it's only a basis point or two, and it'll help us a lot." And so that's happening. Everyone's looking across. Now, what's interesting is what's actually driving some of that movement is US headquartered firms. Yeah. With large European operations who've always seen MiFID 2 as a headache. They've run themselves in always the same way, regardless, in the United States, and they've ring-fenced Europe to comply with MiFID 2. Now, if they can unpick that and have one global process, then they will be very happy. And that's a good defense. You ring up your asset owner client and you say, we're going back to charging you a basis point and a half for research. And they go, why? And you say, well, it's important for flexibility and it's important for being able to access the right things in the middle of the year and all that sort of stuff. But equally, we're just trying to align with the regulators aligning, and we want one global process. And that's what we're going to do. Are you on board or not? And the fact that European asset managers know that American asset managers are saying that is giving European asset managers a bit more confidence that this could be an industry trend that they could get along with. Because until those big North American headquartered firms started to look very interested in taking advantage of this sort of retrenchment of the FCA and of ESMA in the European Union, I think there were a lot of people here who were pretty skeptical in the UK especially, going, how am I going to call up someone in this environment? It's been tough for AUM, it's been tough for performance, and I've got a call, I'm going to put some more cost on you. Well, that conversation is not going to end well. But I think the fact it's going to be an industry trend and the fact that global firms are pushing it, I think gives some air cover to that.
You said a couple of things there, and I want to pick you up on them and help educate me, because it was only recently I suddenly understood the difference between asset owners, asset managers, and then you've got sell-side brokers. I understood sell-side brokers and asset managers, but I lumped the buy side into sort of one lump.
Yeah.
And it was when we were talking about index pricing and ratings. And it was when I learned that this concept of a mandate from an asset owner to an asset manager was incredibly restrictive. I mean, that's maybe when we get onto cost management, we'll talk about that.
Absolutely.
But in terms of this research flow, this research payment, asset owners, asset managers, and then brokers in the big investment banks, how does that? I don't understand the full flow of who's paying what, where, how. In the bit of the conversation we've just had,
yes,
can you break down the flow between those three types?
Absolutely. So I'm the asset owner. I've got some money, so I'm a pension fund, and we've decided our allocation. We want 30% of our equity allocation in European assets. And so I have a consultant, also do some work myself, and so we've decided that asset manager A is the best one for these European funds. We've looked at their performance, we've compared them against the market, all these sorts of things, and we've decided, right, okay, we're going to ring them up, we're going to give them this cash, and they're going to invest this cash on our behalf into Europe. And they will make the stock picking decisions. Yeah. We have made the asset allocation decision.
The mandate.
Yeah. We will give them the mandate, and off they go. And then they, just like you or I look, at anything we've invested in, you get a report at the end of the year, and it tells you basically how it was performed, how it performed against the market, and also what you paid for in costs and charges.
Yeah.
And so research comes into that. Now, before the simple thing about rebundling and unbundling and bundled before it is, before you just got told, right, you got charged this much money, and it was called like trading commission.
Yeah.
But inside the trading commission, loads of it was for research, and I just didn't know that. And so I didn't ask any questions about it. And so the FCA, and I think actually the industry was a bit like, does any of these people actually care? Do these asset owners actually care? These are small amounts of money. It's more about the performance. In the end, they either buy us, use us, or they don't use us. But in the end, a reasonable amount of the asset owning community, responded to surveys and things like that. But in the end, it was very much regulator driven, not end investor driven. And so anyway, so that's how it works. And so if you think about that, right, I am the asset manager. I have now got a budget that I've recharged through to the asset owner. So it's not coming out my P&L, and it is a certain amount of money for research. And basically, that went up and down with volumes, because if it was just, I paid alongside a trade. So I used to be a research provider, so now we go to the provider side. And so I give you access to my analysts, and the stuff that really moves the needle is the one-on-one, this type of face-to-face conversation. That costs a lot of money. You read a PDF, that costs less money. Get access to a portal, that type of thing. That's very scalable if you're a bank. And so what happens is I then charge you, the asset manager, the money. That money then gets recharged back to the asset. And that's how it worked. And that's what the FCA was looking at and thought, we need to clean this up. We need it to be more rigorous. And everybody, I think, would argue now, it's very rigorous. And so, and I would say a lot of the banks would say that it's way too rigorous. It's stopped us innovating. It's meant that we've cleared out a lot of cost, and we've also reduced our coverage. And that's why this retrenchment's happened. And so maybe we're getting to a place where there's a certain reinflation of the market. It'll reinflate in different ways to what we lost. But it has been a bit of a strange ride.
And there's a lot of cost to regulatory compliance. I mean, there's the admin overhead of trying to manage all this also adds a layer of cost that wasn't there before.
This is perfect, David, because I've been watching this, and so obviously, I mean, we started because we thought we were going to be TripAdvisor in research. We started building AI algorithms for pieces of research and for portfolio managers, because we thought in the end rankings don't work in research in the sense of certainly the ones that were that are out there in the market. I'm sure they're very interesting in terms of actually matching a portfolio manager to an analyst and the analyst output. That's a dating sort of situation, not a who's best, because best is in the eye of the beholder very much in research. Your research might be very useful to me and not very useful to someone else, depending on their career and what they're looking at and their process. And so in the end, what we realized is, how is this infrastructure going to play out? Now, I'm going into a lot of different buy-side players talking about our TripAdvisor work, and they went, Mike, what we need is Compare the Market or Money Supermarket. We need to be Martin Lewis, not the holiday program. So that's when we went in and started taking all the data and started doing benchmarking and research. And so we took that role, and we'll talk about this a bit later when we go into benchmarking, but we were given one clear brief, which do the apples to apples job so that we can use these actually in a meeting and actually affect our outcomes. And so then when we started looking, we thought, well, what's the infrastructure going to be built around this because of the compliance and regulatory cost? There's only so much budget to go around. And so we watched is the infrastructure in research, all these launches, loads of businesses launched in MiFID II in research. And some of them survived and a lot didn't. And one of the ones that survived was the TRG or the Calero of research, which is ComSize. And ComSize takes in all the data that says, right, okay, you are asset manager X and 50 of your fund managers had meetings with broker A, and you went to 32 conferences that were run by broker B, and met lots of CEOs of companies, and you got a model built by broker C, etc. And so it tracks all the consumption, kind of inventory management, contract management, invoice management, all that nuts and bolts stuff that you'll be very, very familiar with. The ComSize do that in the research space. And ComSize, I watched them get bought by Euronext 6 years ago. And so, with interest. And I watched a person I got along with and I had a lot of respect for, Amrish, have a good experience. They let him run his business, they invested in the business, and I watched him, go through whatever hurdles he would have gone through with the structure of the deal and then stay for the longer term. And so we got talking with that side. And so very much, I knew when we started doing due diligence and we had a number of firms looking at us to acquire us, that the Euronext name would raise a couple of eyebrows. But then I also...
Independence. I mean, that was the
absolutely.
thought that came into my mind.
Absolutely. And so one of the things that I looked at very carefully was, right, okay, so we're in this sort of private equity-like growth bit of Euronext, this ring fence bit. What other businesses are there and who do they do business with? And when I saw that a great swathe of my client base was already working with ComSize, or certainly sending data into ComSize in lots of different ways, I started to entertain it. And then obviously you then go into governance and ring fencing and all those sorts of things, which was very important to me.
So it is obviously tightly ring fenced. I was intrigued you said of this private equity. So it's literally sort of Euronext just investing in businesses, because and then we should move on because I'm conscious of the time.
Yeah.
When we talk about cost management and benchmarking, you might be looking at, you shouldn't be spending as much on Euronext data from an exchange or benchmark.
Yeah, absolutely.
That's an awkward conversation. Should we go into cost management? Let's
Let me address that, because I think it's really important, because it was fundamental. And I suppose the number one thing for us was we had been doing 4 years of work on price benchmarking, and we'll talk about it a lot. But we were driven to areas of inconsistency, of big differentiated pricing. And that was rating agencies, index providers, ESG terminals outside of one obvious provider, and a few other bits and pieces. And so really, the client base drove us. Our coverage is always driven by what people want us to benchmark. Yeah. And when we talk about benchmarking in a minute, you'll realize what this is. We're very much driven to where the pricing is inconsistent. And so we weren't really driven to the exchange world, and we don't really have data that helps that. And so what happened was, when we first started doing the due deal, we looked at it. Now, we will benchmark whatever we need to benchmark, but very much we are being driven into these segments by the client base, and that's where they see the inconsistency that they want us to focus on. And so I think the key thing in terms of how we ran ourselves is, if you can imagine the type of data we're taking into benchmark, ring fencing is always a huge thing, even within Substantive. Like, only certain individuals, certain, very, very protected platforms have this data and normalize it, aggregate it, anonymize it, etc. And so for us, I was actually very comfortable, because I thought, okay, this is going to raise a couple of eyebrows. But then we've got a very visible checks and balances conversation to have with everybody. Actually, because there wasn't a single potential acquirer that doesn't have a potential conflict of interest in one way or another. And I thought personally it's absolutely hilarious when a couple of people mentioned conflict of interest to me. I won't say which organizations they represented, but I walked away from the conversation and I thought, did someone at that organization just talk to me about conflict of interest? It's very easy to a small startup to say, that's trying to grow, invest, and expand, that it's something that needs to be addressed. But the fact is, we've had more scrutiny than you can imagine, and I'm very, very confident with it. And actually, it's been very exciting. We'll talk about the expansion later, but it's allowed us to do a lot more.
And I think that the two topics, cost management and benchmarking, is it one topic? Is the way you've addressed cost management, I know you talk about it in conferences or whatever, but was it driven by the fact you're benchmarking? The purpose of benchmarking is cost management. Is that a correct statement?
No, actually. Benchmarking is about just knowledge. What you decide to do with the knowledge is up to you and the situation you're in and how you feel about the knowledge. So we would never say someone was overpaying or underpaying. We would say they were over or under benchmark. Why is that? Well, because we grew up in the research world where maybe I want to pay you more, 30% more than everyone else is paying you, because when the market hits the fan, I want you to call me first.
Yeah.
And so we've kind of been born in this understanding that you shouldn't be telling people, you're doing worse than other people in this area. Because we don't know everything about you. You're a client of ours. We don't know everything about you. There may be very good reasons why you decide to pay at a certain level versus the rest of the market. But what we want to do is identify that and have you have confidence about that. Now, of course, it does align most of the time Or certainly when someone's decided to sign up, they go, well, we're worried about costs. We want to understand what we're paying and where we've got some opportunity to actually kind of become more efficient. But in the end, when they get it and they start using it, it just feels weird not knowing after a while. So sometimes they just go, oh, right, I'll give you an example. You're paying 15% more than you did last year, and year on year in your 3-year renewal, you're doing 6% each year. So a very familiar type of conversation that will, depress the hearts of many that are listening to this, and maybe bring joy to others. But anyway, the point is that you're in that situation. Now, you do some benchmarking. You find out that the rest of the market actually is doing 22% this year and 8% year on year during the renewal. Now, what can you do now? Well, you can do a number of things. Now, we can do what you've always said, which is surely benchmarks just tell you you've done really well and you tell your boss that you're great. But you go up, and unfortunately, I don't think anyone gets showered in champagne in this market. But at least you go up and you say, look, I know there's been a lot of adrenaline about this particular renewal and the business is pushing back about the internal spend allocation and all this sort of stuff. But the fact is, we've gone 7% under on the first bit and 2% under year on year. I'm not saying buy me a car or give me a medal. What I'm saying is the focus is better spent elsewhere.
I mean, going back to a couple of points, I mean, the point you made, I think, is interesting. All the points you make is interesting. But the point I pick up on was data has no opinion. In other words, having the data, you then interpret the data and have an opinion on it, but the data itself is just useful. But again, a cynical point, and you gave me permission to be cynical before.
Yes.
So I'm gonna throw some cynicism at you. One friend of mine at a bank who does pay for benchmarking says it didn't help us at all, didn't give us any advice, but at least we were doing something. We could demonstrate to management that we were trying to do something. It was almost like just proof of some sort of action.
I mean, that comment to me is the bad old world. And that, why did we get to arrive in market data? Like, we weren't here, as you know, 10, 15 years ago, we weren't in this world. When we were working in this world in one way or another, I was negotiating with providers at, previous places. At my old shop, we were buying data assets. But why were we allowed to come in? Because we were the apples to apples people. So we'd already done it in research and everybody was already using it. We'd proved it. And I'm not saying we did it quickly. We got it wrong about 16 times. But we finally got it right and people used it year on year. And so it was sort of, you're spending more than everybody else in this area. Well, that's fine. But the fact is that in the end, you need it to speak to your own use case. And what I think is very interesting is you take someone like Expand, working on the spend benchmarking. And I think they spend a lot of time on that apples to apples challenge. Then you look at us, looking at that vendor side, product side, the more granular side of this, sort of bottom up as opposed to the top down. Right. And again, we're spending all the time on the apples to apples. And what's beautiful about this market, unlike research, is you get these enormously complex ways that everybody's charging each other, and you can build the Lego bricks. And it takes a long time. It takes immense depth of data, which is why it takes so long to do. It took us twice as long as we told our clients it would take. And actually, a number of them said, we wouldn't have believed you were doing it right if you hadn't come back here with your tail between your legs saying that you've only got halfway through. But the fact is that what did we do right? These people who've gone, oh God, you're not going to come again and tell us that you can benchmark. Someone always comes every 10 years and etc. I'm talking a lot about the buy side here because obviously there's people with more tenure on the sell side. But what we managed to do is show that we thought enough about this and this apples to apples job that they then carried on talking to us and helping us, believing that we weren't just letting the sort of, the important insights, the pearls of wisdom just fly by. And we actually used it and built it in the model. And so we just kept iterating. And in the end, they keep saying, yeah, but what about this? I'm 30% passive and I've got a marketing location in Dublin with only 3 people. And also I don't buy this extra product on the side that might corrupt this. And so they keep saying, what about this? What about this? What about this? And so every time they say, what about this? That might make me different. You build the model again. But and you get there.
I mean, it must be, I'm going to stretch the metaphor to destruction.
Yes.
The apples with apples, you don't want to compare apples with pears or apples with steak or something.
Yes.
But then I'm living at home and I go and buy some apples from Waitrose or something. That's different to a restaurant that makes apple pie. That's different from a factory that produces apple pies that sell to Waitrose. I mean,
exactly.
I
Exactly.
mean, it's not just the apples, it's those.
Well, I'm going to leave that taxonomy job to some of your previous guests,
Yeah.
and I very much welcome them working on that because, obviously, we have to have internal taxonomies for our benchmarking. But the one thing we don't do is we don't say, "Oh, this index you think is a lot of money and does this particular job for you. Well, why don't you look at this one?" Because I haven't been in market data for 30 years. I could sound stupid really, really quickly. Where I don't want to sound stupid is the apples to apples of the data that we bring together and the quantitative models that we build to do that. But what we won't do is that, because benchmarking is a big word.
Yeah.
And so benchmarking can be alternatives. We don't do that. So I will tell you if a particular new entrant provider has got to a certain level of adoption in a market, because I can see in the data that we get that people are moving across. But I won't tell you if it's good. There's an inference of whether it's good if people are using it, but we'll always go to that data. So what we're doing is we're looking at each provider in isolation and the consistency of their model. So if I tell you this is what drives my price, is there an area where actually, if, as the consumer, there's a particular license or particular product where I'm out of whack with the rest of the market? And so price benchmarking, line by line, provider by provider, is achievable. Price benchmarking when, the apple at Waitrose might be tastier than the apple at Sainsbury's is a much more amorphous thing to do. But the beauty of the inconsistency in this market is I think it helps both sides, because I think that vendors, with the best will in the world, would really struggle to price consistently, even with their pricing models that they represent, because they've gone through mergers, you've gone through mergers, requirements are changing, tech's changing all the time. And essentially, you end up with these very useless adversarial conversations. Whereas if you could help people hone into a particular license or a particular product and say, this is the area where we feel we're being treated differently to everybody else, then you can actually hone in, everyone have a look at the situation and try and get to a place you can move on. And that's what we see every day, every week with clients.
Well, and let's hone in on something, which I think is a segue between benchmarking and cost. Transparency.
Yeah.
Because, again, I'm stretching this metaphor. By the way, anybody's in America or Asia, Waitrose is an upmarket supermarket, Sainsbury's mid-level one, and we could talk about old translation for Americans and Asians or whatever. But again, if I went to the supermarket, I can see the price on the apples.
Yes.
They're credible. But imagine a situation where I turned up at the supermarket and I went to the checkout and they said, David, yeah, apples for you, 20 pence. Great.
Yes.
But that bloody Mike Carrodus, he's rich, he's loaded, having, Euronext bought his company. So I'm going to charge him 3 times as much. But don't tell him. I suppose the point, and the point of criticism that I hear often from customer firms is that you can't see a price list. You can't see the prices from all these different vendors. I remember when I used to work for Reuters many years ago, we did used to publish a price list.
Yes.
But I don't think they do anymore. And I've heard, especially from index providers, rating agencies, a criticism is that actually pricing isn't transparent.
If it was, we wouldn't exist. So the question is how far, should things change when it comes to transparent pricing? Our clients actually have really different answers to that question. Some of them like to add value, internally by being better at negotiating. Sometimes vendors will say, you want consistent pricing? Well, we'll give you consistent pricing. It'll be all up here. Which I think is a pretty adversarial message, actually. It's like, right, you want us to print a menu? But I do see that it's difficult. And I do see how much everything's changing. And I see how technology is affecting what they do. But the fact is that even with the best will in the world, these models aren't being applied consistently, and even if there's a notional list price, it is not consistently applied. And in some areas of the sectors that we cover, the discounting is quite consistent, but the actual identification of the list price is not. So, which I always think is amusing. So it's basically, we'll take off the same amount, but we'll just start at a different place. And so but like I say, in the end, I think that it's an industry problem. I don't think it's necessarily something that you can point fingers to aggressively at people. I think that the situations, we've unpicked all of this, and it's taken years and years and years of matching and creating each brick. And in the end, what's helped us is you use some stuff and you pay some money. So however much everybody decides to price that or create that, my use case, it's like how a lot of people say, my use case hasn't changed yet, I still seem to be paying more. Even when you account for inflation. But that's a real help for us, because basically, as long as we can tell what people are using and why they're using it and how they're using it, and we understand the use case, then you can do the apples to apples job. But like I say, it's not simple, and it requires a load of quant people working all day, every day. There's no back of envelope you can do in this world.
And let's use this as a segue into cost. I mean, you've got all this, you paid, you guys good money, and you've got really good benchmarking data, and you've got all this, and you can tell that you're 10% paying 10% more than the guy next, all of this. And then you go to your vendor and you say all this, I've got all this information, how dare you, I demand a 10% reduction. And they smile wryly at you and they say, I don't think your figures are right. And anyway, look, I can't do, that's what it costs. If you don't like, they don't say this, but effectively the implication is, if you don't like it, run along. And the one thing I've noticed in the market, especially with buy-side institutions and what they pay for index and ratings, it's like they are very uncomfortable. They moan a lot. They complain a lot about it. But when one delves into it, it's like they have no negotiating power. And therefore, I don't want to say anything rude. I do feel like saying it's just, take it. You have no choice.
No. I think this is a really important point. And this segues into cost avoidance a little bit.
Yeah.
So you're right. But if you take someone like, people like Rudy at the German Investment Funds Association, I mean, the one thing I would say, if Rudy had a sentence to say now, it would be resistance is not futile.
Okay.
Because yes, you are going to have a relationship next year with those people. Yes, they're pretty have to have. But the point is, it's got to work for both of you. And there is a limit. And the fact is they do want to have a constructive relationship with you, and they want to grow that relationship with you. So therefore, at some point, you're going to have, in most cases, a functional conversation. And so if you are having that functional conversation and you have done some benchmarking and you say, David, we've worked together for 20 years, we've got a great relationship, we're looking at a few other products. On this particular license, you and I both know that we're completely out of whack.
Yeah.
And so, and my management are just saying, how on earth can we sign this when we know that this is the case? And so then David goes off and has a conversation inside his building. And they say, well, to be honest, yes, fair enough. They are being stung on that license. But the fact is that they said they were going to sign up these extra products and they didn't last year. And so then you have that wider conversation. So, and like your previous guests have said, these are all ingredients. And sometimes that sounds like a cop-out. But I really feel like we're getting into a mature place in this market where actually it's becoming very clear there's certain tools that actually affect outcomes and ones that don't, and that this is, some of us are growing very fast, and there are a lot of people that you've been talking to. They're all organizations that are expanding their client base very quickly. So for me, that says to me we're getting to a more mature phase where, okay, I understand, I'm going to come back, and if I can just complain at you, we're not going to get anywhere. But if I understand my usage and I can point that you bundled in 3 products that haven't had a single click on them in a year, and if I can also point to the fact that we haven't done anything wrong and that we, et cetera, and that, I can show you evidence that's of this and that we've kept to everything that we've said in the agreement, and I can also show you that it looks like, we feel like we're being treated very badly on this particular license, and that, et cetera, and I can also show you where I might be buying more next year, then maybe we're getting to a more functional place.
And I mean, that's my observation, that the industry, the subsector of the industry which you're part of, which is measuring, counting, tracking, whatever, that knowledge, that data, and the sophistication of that data and the breadth of that data must enable a Rudolph or whatever, although he's a trade associate, but the entity that is trying to negotiate, it gives them a better chance of negotiating. I'm using my words carefully. It doesn't guarantee
like a lot, right? It feels like a lot. It's all these different companies, and I've got to do benchmarking over here, and I've got inventory management over here, etc. This, but it reminds me of a conversation I had in the 90s at HSBC in Hong Kong, and we were all talking about WTO and Shanghai entering the market as a financial center, and I don't think Pudong had even been built then. And so we're on top floor of the nice HSBC building, and my chairman of the place I was at the time goes to the Asia CEO, about Shanghai, is it going to compete with Hong Kong as a financial center? And then this very respected, I was amazed I was even in this company at that age, and I'm trying not to spill any food off my plate. And he starts me, he goes, the thing about China, guys, is, and he goes, And he paused radio. I thought, what amazing thing I'm going to hear now. He goes, it's very, very, very big. And, he was being funny, but his point was you could have 6 financial centres by the time this market fully expands, et cetera, et cetera. It's kind of how I think about this. You've got hundreds of millions of dollars being spent on market data, and you've got these 4 beleaguered, battle-weary veterans trying to administrate that budget and work with demand and all that sort of thing and usage, etc. And we're talking about a handful of vendors out there trying to help that and scale those people. I think we're very early in all of this. I mean, market data feels to me like pre-financial crisis, the transaction banking part of a bank, the cash management people, where they were always kind of under-resourced. Everyone thought the structured credit people were the sexy people. But then suddenly 2008 happens and everyone realizes the cash management guys are the only people keeping the lights on in the bank. And this feels exactly the same to me. These under-resourced teams who the visibility of the C-suite isn't quite there yet. And everyone sort of feels like, when's that going to change? There are triggers. And I think right now this market's going through a cost focus that is a trigger. So for me, this whole element of all these vendors coming together is about trying to give these people who are starting to get appreciated, we're just at the beginning of that curve, the tools they need.
But I've picked up a vibe when I talk to lots of, especially on the customer side, is that the market data teams, those beleaguered 4 people, who are trying to do all these things, there's an enormous millions and millions of dollars being spent on market data, but only a tiny proportion is spent on the market data team, and the market data team is the people. Salaries, etc. But then it's all the tools, being able to pay people like you, firms like you, and Expand and TRG and so on and so forth. Again, I'm going to throw in a personal thing. I mean, I'm doing training courses out there and I talk to people, oh, we'd love to do this, David, but we've got no training budget. All these, we're investing in our people, but they won't then have a training budget. So is that breakthrough? I mean, you've noted some optimism there, but I'm still a little bit concerned when I look at all my contacts that these firms are not really investing, the big banks and maybe even the buy-side institutions, even more so, are not investing much money in the teams that are managing the market data.
Yeah, and I think the core of all of this is the understanding of cost avoidance. Before I even got into particularly the worlds of research and market data, one of the things that interested me most was I thought organizations were terrible at opportunity cost.
Yeah.
So I'll give you examples. I was a young sales manager, and there was a couple of older salespeople, experienced with big flows coming through their desk. So big clients, money just flowing through their desk. My fresh pair of eyes was like, this person's not doing any work. They're hopeless. But so I go upstairs and I sort of say I want to make some changes on the sales team. And they go, oh no, they've got a big number next to them. And they go, but these other person's not seeming to perform, so why don't you get rid of them? And I'm like, well, they've been here for 6 months and they haven't really had as much training as they need, and I'm pretty sure they're going to be amazing, so I don't really want to fire them. And I realised there was this bias on, right, there's this big number next to this person's name. And so therefore what they weren't doing was understanding the opportunity cost, because they saw 2 million quid coming through that desk. They didn't realise it could be 4 million if they had a better salesperson there. And so, I'm simplifying the situation, but that's essentially what it looked like. This is exactly the same, only the flip side is the cost side of things. Because the problem is, you've worked really hard. You got your tech people to get you the usage data that meant that you then looked at the bundled things that actually didn't add value. Actually, the vendor took that. You did some other things. Maybe you did some benchmarking. Maybe you also looked at your location management. You moved some things around. And so you've come back and you've taken what could have been a 30% increase to 10%. The problem is, who is the validator of what the par score was? Was that 30% ever real? Or was it the double glazing salesperson coming in and going, do you know what? It's a Thursday in April and it's 50% off. And what, a lot of people do in that situation go, well, that extra 50% never existed. We're starting at that price. If you're going to give away a discount in the first millisecond, then that price never existed. And so the problem with market data teams is identifying the return on investment of their efforts, because no one's identifying the par score that's what sort of beta cost avoidance, which everybody should do, and alpha cost avoidance, the blood, sweat and tears that are those hard yards to push something down. And obviously I got interested in that because we're benchmarkers. So therefore we can see that an average discount at the very beginning of a negotiation is this amount of money. And then we can help people start to identify quantify. Will the finance function ever really believe that number? It depends on the culture and the organization you're in. But certainly working with the businesses, you start to get their buy-in and look at the real situation. I think people start to understand what's really being achieved, and the fact that something going up doesn't mean that actually a lot of shareholder value wasn't created in the fact that it only went up a certain amount.
And are you seeing, when you organizationally, I've tried to have a few conversations with user firms about this, the market data team and all the elements within a market data team alongside a procurement team, but then they somehow seem to be reporting into maybe some sort of COO or something, or you've used the word the business. It varies organizationally where they report into. But what's your sense when you talk to your customers about the relationship of the market data team with some other elements in the bank that are going to be the more senior or the ones that have more power? How are you seeing that dynamic? Is that dynamic changing, or is it problematic? Or
it depends, and every place is different, right? Which is an easy answer. But I would say in the round, I would say that the C-suite's enormous focus on cost control in the last year to 18 months has made that relationship closer. So, just for us,
and you've seen that. Seen that.
Well, we see it because we get signed up, right? So we're growing fast. Sort of 40% a year. And why is that? Well, it's because the buying decision gets made quite quickly. In comparison to, and we're not a big infrastructure that has to get plugged in, right? So you either want to know or you don't want to know. And yes, we've got nice dashboards and all those sort of things, but fundamentally it's providing data, it's providing transparency, right? So in the end, the conversation has to happen from the C-suite to our counterparty, our daily counterparty. And what I've started to observe is certainly in the last 12 months, that conversation seems to be much more rapid and direct. Because what's happened is, it's been unfortunate to be seen as this enormous cost center when the poor market data people aren't the people using the blooming data. But anyway, this big cost center that's sort of thrown around organizations and sort of blamed for things or pushed to do things. And as you say, between a rock and a hard place, between the demand and the cost control. But also that does give them in these sorts of times a fairly direct line. And I'm finding that line more direct than it has been, and so often when we'll deliver stuff, we'll have C-suite coming in, especially when we do the bigger picture stuff. They don't want to get right into one reporting license, for half an hour, in the same way we would do with our counterparty, the individual. But what I have to say is that definitely that C-suite focus on cost is more strategic, more forensic, and starts to ask these people, what can we do? And so that's a tailwind for us. I've always said this market's a bit like a sort of circus full of people who people have always said to me, well, hire another 10 salespeople and then you can grow 10 times as fast. I go, no, it's not like that. About 10 firms get sort of pushed out of the 10 who've decided they want to do benchmarking. And then they go, we know you use the benchmark, and they call us and they make sure that it's rigorous, etc. But the point is that everybody gets there in their own time and through their own cycles. And I think the C-suite's absolutely fundamental in that, as it always is. But right now is a definite tipping point.
Mike, I told you we'd get to this. We're at about the 50-minute mark.
Right.
So on cost, we're into cost. Give me your highlight. What's the advice you offer out to your clients? Where are the most opportunities? You talked about opportunity cost. Where are the most opportunities in cost reduction, cost containment, cost management, cost avoidance, all these different, where can things be done? Where should you start?
I honestly think, obviously, yes, get your inventory management sorted, get your benchmarking, whatever, all these tools are great. Obviously, I'm going to say that. But I honestly think we're at such an early phase that just another person for your poor market data team is the easiest ROI you're ever going to get in your life, in your organization. We work with the buy side, with huge amounts of buy side. And there are products always being pitched to the buy side that you'll get this many more basis points of performance if you have this tool or this quantitative stuff or, whatever. And I always think, and it's always so sexy, and the people pitching it always have mad professor hair and 17 PhDs. And I think that's great. But some of this is the boring hard yards. Just give. They're dealing with 400, 600 contracts a year. And you think that of course they're cherry picking. So you're telling me that two mid-level people on that team with a bit of tech around them and, the right tools that don't cost that much, actually, in the, grand scheme of these budgets, are actually incredibly, rounding error, doesn't create an enormous return on investment. I mean, it is remarkable to me.
I mean, it's a phrase I can't remember who I was talking about. Can you actually measure return on investment of a market data team? Can you actually analyze that? I mean, that strikes me. I mean, I don't know if this is pertinent, but I always remember a good friend of mine many, many years ago said something. He said, David, when I'm going out selling, I'm knocking on doors, and I'm knocking on the doors. I've got this great new product. It's called a £20 note, and we're selling them for £10. And the answer I often get back is, that's great, but we've got no budget. It's like if something really fantastic comes along, there's such a mechanism, process. And I suppose those budget processes have to be there.
Yeah,
but
I was there as a startup. There's 10 things that are going to give you an enormous return, but you've only got cash for 3. So I mean, I get it, right? But in the end, what's the trigger? And we're all human. You know what I mean? So you're a C-suite. There's only so much you can give attention to. So what is the thing that wrestles, your attention? And so you need some macro stuff. Well, we've certainly got lots of that. And actually, we just need the right presentation, the right metrics, the right measurements. I mean, you just talked about it. Can you measure? I think cost avoidance is a really important part of that. That's why we're working on this framework. And it is amorphous. You're trying to nail it down into a model in a spreadsheet, and then move it into something at another level. Maybe we never get there. But the point is, can we add greater credibility to a performance assessment of cost avoidance that feels credible, real, and authentic? I definitely think we can take it further on than that, and not just us. I think everybody, the type of people that you speak to, can be part of that, and it's one of the reasons that we're really happy to write about it and talk about it very publicly instead of trying to hide this framework inside our building. We all know the tools that contribute to cost avoidance. I think we add one really, which is where is the par score that you then start counting cost avoidance from, that's not just a giveaway discount that everybody gets. Right, okay, so this is the bit where you're really negotiating from, and so therefore everything here is actually hard-won yards, driven by best practice. Measure that. Don't just measure it to say, right, this team saved us 6 million this year versus 4 million last year by being clever and looking at alternatives and all the sort of efficiency gains that you have. But also, what got us there? Was it the fact that we're one of the few places that the tech team are fully integrated with the market data team and that we've just got better knowledge and then that's how we use it? Or is it because actually the way that we manage our locations is cleverer about the way that people use data or whatever? Or are we better at, et cetera, all the different things that contribute? Because that means you can then tell a C-suite, we're really good at this bit that stops us having this much cost, but we seem to be rubbish compared to everybody else when it comes to contract language negotiation.
I mean, that we're almost at the end. So hold you ready for your last final points. But
yes.
that point there, that analysis of the market data team, that cost avoidance versus cost reduction. I mean, cost reduction is just cut by 5%. What you're saying is identify where you're able to cut and where you have been able to cut and do the analysis of that. And then if I picked up correctly, understand how what it was that enabled you to do that cost, because maybe that's something to do more of and focus on and tune to better perfection and what have you.
And now I'm interested as C-suite. At that point, I'm interested.
So we've got to conclude. I mean, I told you we'd run out of time. There's a million other things we could still talk about. But if I give you your chance, if there are 2 things that you haven't said that you really wish you had said, the 2 messages you want to leave the audience with, what are they?
What's our main competitor? As you can tell, we didn't think it was Expand because they do a different job and we embraced them. We did a white paper with them and it was fantastic and I think worked very well for both of us. And, we're looking at integrating with lots of people. I love what Expand and Calero are doing and we're getting involved with them. We're also talking with Lee at TRG. And I think that whole integration is a really important next story for us and for the industry as a whole, because in the end, we need these people to have to do less, these 4 beleaguered, battle-weary veterans. So if that means that they don't have to fill something in for us because we've already got access to stuff, and that also we can deliver back through the things they've already got access to.
So that integration of all these
everybody
tools.
wins. So that's just, that for me feels like a no-brainer, and I think it also feels like a no-brainer to the people I've just mentioned. So that is just ongoing work, but it seems like low barriers to getting there. I think the main thing from a competition or a hurdles perspective is Mike, I've been 25 years in market data. I know if I'm getting a good price.
Yeah.
Now, I know that feeling. You know that feeling.
Yeah.
But in everything that people really care about, they become data-driven. And things change. And so you're always going to get messages. We have never delivered to anyone without surprising them. And so I get it. I get it that you go on to coffee with a few people and you feel you get the lie of the land. But like I say, we've got a 94% renewal rate. That means we always deliver surprises every year. And they're not like, you should be doing this, etc. It's no, the market's moved, something's changed with certain models. Some people have adopted that model, some people have managed to push back against it. And this is where you are against this moving spectrum. So there are areas where, you should focus less, and there are areas where you should focus more. And actually, you're pushing on an open door in some of those. That type of knowledge to people who have been around for a while means that you can use it really effectively. And so what we find really wonderful is that first sort of, I've been around for a while, I've had a bit of benchmarking stuff that, been pitched to me, and I'm never been quite convinced. That's why we do proof of concepts. Because suddenly you realize, okay, actually, this granular level is actionable. And so what I would always say is just give it a try, because actually, you're in an asymmetrical situation, a leverage situation as a consumer. There's a reason that we're all growing and that we are all, a renewal rate is one of the most important indicators of value add in a world where cost is in focus. And so for us, we work on that very, very carefully. And I think for that reason, I'd say embrace the benchmark. It's going to give you some transparency that you'll use.
And what a good way to end. So, Mike, this has been a pleasure. And again, we didn't get to talk about everything, but I think we talked about a lot. So again, I hope people comment on this. I hope bucket loads of people sign up, and not just renew, you get a whole loads of new customers. And then you have to buy me a really expensive lunch at some point.
Definitely. And I really appreciate the invitation. And, well done for creating this series. I think it's been a really, really important industry resource.
Well, and let's hope that continues. So we're going to say cheerio online. So let's say our goodbyes now. Goodbye, Mike.
Goodbye.